All right, let's get started with our chapter 10. We only have one more chapter after this, which is crazy. So, sorry. The chapter itself, I think it's going to be about as long as the chapter 9 one. So, we're going to cover the information to do the last project in this chapter. And so chapter 12 is super short. I'm not sure why I didn't put 10 and 12 in week 7 and put 9 by itself, but that's kind of where we're at right now. So, as far as the lecture goes, this chapter is all about liabilities. The whole chapter is about liabilities. And so, a liability is when we owe something. It's not necessarily when we owe money, because remember, unearned revenue, we owe to service. And so most of our liabilities end in the word payable, but not all. The cutoff for a current liability is 1 year. It actually has this extra little part where, or the operating cycle, whichever's longer, but you guys don't need to worry about that. So a current liability is short term. And so that says R. So current liabilities are short-term obligations that will be paid with current assets within the current year. So most of the liabilities we know about, let's see, accounts payable, notes payable, interest payable, wages payable, and then unearned revenue. So most of them end in the word payable. So accrued liabilities is a fancy word for a bunch of different liabilities that are amounts that we owe. So it could be like wages payable, interest payable, those kinds of things in there. Accrued advertising and promotion is something we don't do often, but when you send out coupons to your customers before year end, you have to estimate what the potential cashing in of the coupon would be to get the matching principal taken care of, but we won't do any of that. So, but we need to talk about some payroll stuff. And so as far as payroll goes, the payroll creates some liabilities. Now, you guys did wage expense, wages payable in chapter 4, where we owed our employees money at like month end or year end, but we also have actual payroll taxes. And most of you guys have probably worked in some form of a job, so you're familiar with payroll taxes. So what happens is we have employees and they work for us, and then we withhold money from their paycheck and give them their net pay. So if I were to hire Keegan to work for me and pay him $20 an hour, and he worked for 20 hours, then his pay would be $400 before taxes. So we all know that I would not write him a check for $400 unless he was like a contract employee or something like that. So I would have to withhold some taxes from his paycheck. Now, the amounts that I withhold for taxes are FICA, which is made up of Social Security and Medicare, and then federal income tax, state income tax, and then any other elective deductions, like if I provide health insurance and he had to pay part of it, or retirement or whatever. So I can withhold other stuff as well. So the things that are withheld from my paycheck are FICA, which is Social Security and Medicare, federal income tax, state income tax, and then health insurance, and then retirement, my 401k plan. And then I put some money in a health savings account, so for extra out-of-pocket medical stuff. And then I give some money to the university for scholarship purposes. I wonder if that's it. I think that might be it. I'm not looking at my pay stub to know, but you can look at your pay stub and you can see the different things that are withheld. And so payroll deductions are like, as they withhold stuff from my paycheck, then they owe that money to the government. So FICA, FICA is Social Security and Medicare. That money is given to the Social Security Administration. The federal income tax withheld, that number depends on how much money I make, and it depends on how often I'm paid, and it depends on how many kids I have, and if I'm single or married, and all kinds of stuff. So when you start a new job, you fill out a W-4, and that says whether you're single or married, and how many kids you have and stuff like that, to determine, or how many deductions you have. They don't have to be kids, you can claim your parents. How many deductions you have, so that they can determine how much should be withheld from your paycheck. And they do that for federal and state purposes in Kansas, because Kansas has a state income tax. So for FICA taxes, Social Security is 6.2% and Medicare is 1.45. So Medicare 1.45, that's on all of your earnings. There's no limit. And so that Medicare money goes to pay your health insurance when you are over the age of 65. So when you hit 65, you can start using Medicare as your insurance. And that's what that 1.45 goes to take care of. The 6.2 is for Social Security. Social Security actually caps out. For 2022, the cap on it is 147,000, and every year it goes up a little bit for inflation. And so basically, this is funny, if I made $200,000 a year, I don't. But if I made 200, then when I hit 147, that would happen. If I made 200, it would happen in like August-ish. Then they would stop withholding the 6.2% because I hit the limit and they won't withhold anymore. Now, Social Security goes to pay for retirement benefits for people when they retire somewhere between the age of 65 and 70 is when people start drawing Social Security. There are a lot of people who are very bothered by Social Security. It needs some reform because they are going to run out of money. That's a thing. When I see that money coming out of my paycheck, I try to consider that there are people like my grandma. My grandma's 89 and she just actually moved into a home and she lives on her Social Security. But before she moved into her home, she lived completely on Social Security and she brought in something around $1,300 a month and she lived on that. And so that was her only income. And so she had a farm. She was married. Her husband died in 1994 and she lived on the farm until 2020 and she just cash rented it to somebody else. And then she moved to town. I think it was actually, it was right before COVID. So it was, but I think it was maybe in 2019, not 2020. Anyway, I think of people like that are living on Social Security and I think about my money going to them. And that makes me feel a little bit better. The other thing I feel better about is if something were to happen to me before my kids turned 18, then my children would draw on my Social Security. So my children would draw on my Social Security until they turned 18. And so each one of my children would get something like $1,200 a month. And then the person who raises my children would also get $1,200 to take care of the kids. And I think it caps out. So I don't think they're actually going to get the full 1,200 times 4 because I have 3 kids plus the person caring for my kid. So there is a cap on it for me personally. So I think they get around 3,800 or something like that. But to know that my kids would have that until they turned 18 makes me feel a little bit better as well. And so that's a benefit of Social Security. My dad started drawing Social Security last year because he is 66 now. And my mom is still working, but she just turned 65 in April. So she is still working, but will eventually start drawing Social Security. And it makes me feel good to know that they're going to get money for this. My guess is that they're going to increase this number. And I think they're going to increase it a lot. I think the main way to make this program feasible is to about double that number. And so the people that are making $200,000 and $300,000 pay a little more to cover the people. The issue is that people are living longer. So if you start drawing from Social Security when you're 65, like my grandma did, and she's 89 and she's still alive, then the money is depleting faster than it's being replenished. So it's a complicated topic and I don't necessarily need to get into it with you guys. I need you from an accounting standpoint to know that the money is withheld from your paycheck. And then the employer, so the 6.2 and the 1.45 in total is 7.65%. And so Friends University withholds 7.65%, which is 6.2 and 1.45 from my paycheck. But then the university has to match that. They have to pay that in as well. So I'm going to skip that blank for just a second. And this is like their employees. All employers pay FICA. And so the employer matches dollar for dollar, whatever I pay in for Social Security. So if my paycheck has $200 withheld for Social Security and Medicare, then Friends University would also pay $200 and send that to the Social Security Administration. And so that's a lot of money, right? So they have to match that. So this blank right here is net pay. Net pay is gross pay minus the deductions. And so this is your take home. Your take home is your net pay. Employers also pay FUTA and SUTA. FUTA and SUTA are unemployment taxes. You will never see FUTA and SUTA withheld from your paychecks because employees do not pay FUTA and SUTA. That's an employer tax that they pay. So the employers pay FUTA and SUTA on each one of their employees until they hit, I think it's like 7,000 every year. So I think it's 0.008 for FUTA. And this goes to cover unemployment. So unemployment is something that if you are fired or laid off or those types of scenarios, you could potentially draw unemployment. So the FUTA money goes for the administration of the program. So it's a federal level number, and the number for everyone is 0.008 in your calculator. It's 0.8%. So it's not 80%, because if you take 0.8, that's 80%, but it's 0.008 on your first $7,000 of each of your employees' earnings. So Friends University has to write a check to the government because I'm an employee for the first $7,000 I earn, so that it costs them $56 a year for FUTA for me. SUTA, the rate varies. So the rate that's commonly used in textbooks is an average, and it's 0.054. And what that refers to is the SUTA average rate. SUTA money is state unemployment, and it goes to the state of Kansas in our situation, and that goes to actually pay people who are drawing unemployment. So that money goes to the state level. And this rate varies depending on how many claims the business has. And so if Friends University's rate is 0.054, but then they fire 30 people, their rate can go up. And so it can get higher than that. And if they never fire anybody, their rate can go down. So everybody's SUTA rate varies depending on claims. So again, these are paid by the employer, not the employee. So what we're going to have is we're going to have some liabilities, additional liabilities. And so our normal liability was like wage expense, wages payable, but now we're going to see more than that. We're going to have FICA payable and FUTA payable and SUTA payable and all kinds of good stuff. So let's practice some journal entries. So it's 12/16 and employees earned $350,000 in the week ended December 16th, 2022. Back in the good old days, you guys would have just done, if I said employees earn 350,000, you'd be like wage expense. And then I'm going to skip all the way down here. And you would have done cash. You would have just done that entry. That would be it. Wage expense, cash, 350, done. Now it's going to get a little more complicated. So instead of just wage expense and cash, we are going to have FICA and income taxes withheld. So the employees are not going to get $350,000 in cash, but our wage expense is $350,000. Then we're going to withhold taxes. We're going to withhold FICA payable. And we are also going to withhold the income taxes. And so what we're going to call this is employee income tax payable. Now I don't have a lot of E's there. And so I should probably write out the word income just to make sure you know what that is. Because income tax payable without the word employee is when we pay taxes to the government as a business. So back in chapter 4, we did an entry for when we owed taxes, and we did income tax expense and income tax payable, and the number was 26,110. And so we did that way back in chapter 4. That was when we have taxes that we have to pay on our taxable income, the check we write to the IRS. This money is the withholdings that our employees are going to pay. So this money does go to the IRS on behalf of a certain Social Security number of every individual employee. So it said income taxes are $62,000. It says FICA is at the proper rate. The proper rate is 7.65%. It's 6.2 plus 1.45. So 0.062 plus 0.0145 is 7.65% of the gross pay. So you take that number times gross pay of 350,000, and it's 26,775. So cash is a plug. So it's a plug. It's whatever it takes to make the journal entry work. Our employees thought they were going to get $350,000, but we withheld taxes. So instead of giving them $350,000, we're going to reduce it by $26,775 and reduce it by $62,000. And we're only going to give them $261,225. Big difference. So our employees see this, but we have to give this money to the IRS and we have to give this money to the Social Security Administration. So those employees are really costing us $350,000. They're just not getting that money right now. They're not getting all $350,000. Okay. So then we have to do the employer entry. So this is the portion that the employers pay for payroll taxes. So prepare the journal entry to record the employer's share of FICA payroll and unemployment. So this entry is a new entry and it's called payroll tax expense. We will match the FICA. So whatever the first entry is, we're going to do the exact same number. So FICA payable will be $26,775, just like up here. Whatever the employees pay, we match. Then we'll pay FUTA and SUTA. So you can call it FUTA payables, FUTA/SUTA payable. You can put it as unemployment tax payable. That's fine. So if you want to call it FUTA/SUTA payable, that's fine too. Okay. So that number will be given and it was 2,800. So our payroll taxes are 26,775 and 2,800. So we're going to have to write checks to the government for another 25,575. We're going to write additional checks to the government for 25,575 to pay for more payroll taxes. So those employees, we wrote them checks for 261,000, but they actually cost us almost 380,000 a ton. So, all right, accrued income taxes. This is when we owe money for our personal taxes, and that debits and income tax expense and credits income tax payable. Notes payable. Okay, this is exactly like notes receivable that we did back in chapter 8. I guess that was just last week, right? So back in chapter 8, we did notes payable or we did notes receivable, but now we're going to do it from the payable side. So this is just like notes receivable from chapter 8, except for we're going to be the ones getting the loan instead of giving the loan. So we also did this entry in chapter 2. So this entry is actually a review from chapter 2. So it says, Mumford borrowed 100,000 notes payable on June 1. So just like we did back in chapter 2, on June 1, we are going to borrow cash that we will have to pay back. Cash and notes payable. So in chapter 8, we did notes receivable in cash because we were the ones giving the loan. Now we are getting a loan. So we are the borrowers. We are going to pay 6% interest. The notes due May 31 of next year. So just like in chapter 8, we started the loan on 6/1 of 2022, that we need to do a year-end entry. So on 12/31/2022, we need to figure out how much interest we owe. We are going to pay none, but we do owe some interest that we will pay later. So instead of using interest receivable and revenue, the R ones, we're going to go the other direction and we're going to do interest expense and interest payable. So this is interest we will pay in the future, but we'll use the exact same concept for I equals PRT. Principal 100,000 times a rate of 0.06 times however many months out of 12, always 12. We got the loan on June 1. So June, July, August, September, October, November, December, 7/12. $3,500. So that's the interest we owe as of December 31. We will not pay any interest on December 31. So we do not write any checks to the government on December 31, not the government, but to anybody, to the bank or anybody on December 31, but we will pay it when the loan comes due. So when the loan comes due, looks like this note is due on May 31. And that's the day that we'll pay cash. So we will pay cash that day. I don't know how much. I'll have to come back to that. But I have to pay back the principal and all of the interest. So I'm going to start off, and it doesn't matter what order you do these debits in. You can do them in whatever order you want, but we definitely need to pay back the 100,000 of notes payable. We also need to pay back the interest that happened last year. And then finally, we need this year's interest expense. So to calculate that, I equals PRT 100,000 times 0.06, and this year 5 months happened. So 5 months, 2,500. So in total, we are going to pay $106,000. Okay, so 106,000 is how much we'll have to pay in total, which makes sense because this was a $100,000 note for 6% interest for a year. So 6% for a whole year is 106. Okay, so this is almost exactly like what we do in chapter 8, where we had everything on the receivable end instead of the payable end. But this is us getting a loan instead of giving a loan. So you'll have 2 homework problems doing this. And you'll just do these 3 entries, just like we did on the second tab of our chapter 8 homework. Another thing you have to do on your debt is you have to look at your debt and look and see what's current and what's long-term. So if you have a long-term liability, like a mortgage, and you're making payments on it, you're going to have to take the mortgage and figure out how much you're going to pay within the year. So you can put that in the current liabilities. So it's called current portion long-term debt. So as an example, if I owe $145,000 on my house, but I'm going to pay off 20 in the next year, then 20 will go in the current liabilities and the other 125 would go in long-term liabilities. And so you take your liability that you're making payments on, and some goes in current and some goes in non-current. Another thing that happens is sales tax. And so if you're a retail company and you charge sales tax to your employees, or not to your employees, to your customers, then when you charge them sales tax, you do not get to keep that money. All right. That's one of the mistakes that several businesses end up making, where they don't give that money to the government. They know they're supposed to, they just choose not to. And eventually the government comes in and shuts them down. So I see articles in the paper all the time about it, not the paper, I don't read the paper, but on social media about companies that their doors get locked by the state because they didn't pay their payroll taxes or they didn't pay their sales tax. So it happens all the time. So what happens is if I go to Walmart and I buy $100 worth of groceries, and the $100 worth of groceries would not cost $100 when I went to the register. When I scanned all my items, it would be $107.50. The $7.50 is sales tax. So Walmart collects $107.50, and $100 they get to keep, but the $7.50 they have to give to the state of Kansas. The state of Kansas then distributes some of that money to counties and different things like that. So I think I did a sales tax example down here. So let's go ahead and do the sales tax example down on page 4, and then I'll go back to the unearned revenue example. I don't know why that keeps happening. Okay, so we sold one shirt for $35. The sales tax rate is 7.5%. The cost of the shirt was $7. So when we do a sale of a retail item, there are always 2 entries. We record the money coming in, and then the shirt left the building. Remember FIFO, LIFO stuff? So every time we sold goods, you have the sale coming in, the money coming in, and then the goods leave the building. So the entry will be, was it a cash sale? I guess we got cash. And then we would have revenue, but I'm going to skip a line, and then down here, I'm going to do COGS, and the inventory leaves the building. So I'm going to do this entry first. It's just for 7. That's the easy one. So up here, though, on the sale of the shirt, I'm also going to have sales tax payable because the revenue is 35, but I'm going to charge the customer a sales tax, 0.075. Oh, that's an ugly number. I'm going to use $2.63. So this will be 35 even. So in total, the customer is going to give me $37.63. Sorry, that's not a pretty number. Every time I make up stuff, it doesn't end up being pretty. I need to try harder. I use $100 for groceries and that worked out perfect. Okay, so when we go through the register, we have to give the business an extra $2.63 on top of the 35. So in total, the business will bring in $37.63. They get to keep 35. They have to give this to the state. Okay, so that's how sales tax works. Sales tax payable is another liability. So this chapter just introduces you to all the liabilities, lots of different ones. A lot of it's review though, so that's nice. And that's good because we're getting ready for the final. So I'm going to start writing your final in this next week probably. So the next topic is unearned revenue. So unearned revenue is something we covered in chapters 3 and 4. It's when we earn or we receive the money before we earn it. So we have not earned it yet, but we receive the money early. So when this happens, we create a liability when we receive the money, and then when we earn it, we remove the liability. So we put it in unearned revenue when we get the money. The example we always use was the lawyer example. And then as we earn it, we move it from unearned revenue to revenue. So let's do an example. January 1, Charlie Rangel paid $2,000 for a 2-year membership to the Beam Gym. All right, man, I don't know any gym that makes you pay 2 years in advance, but whatever, right? So Charlie, the customer, is going to give the business, it says Beam here, and then it says Beam here. I'm bad at my job. So the customer is going to give the business $2,000, and we're going to do the journal entry for the business. And so on 1/1 of 2022, the Beam Gym is going to receive cash of $2,000. And that will be unearned revenue because we have to let this gentleman use our gym for the next 2 years to earn the money. So as we earn it, we will record that over time. So we do not earn it until time passes and we let this guy use our gym. If 2 days later, we're like, you know what? We don't like you. We don't want you to be a part of our gym. We would have to give him his money back. We can't keep his money. That's not nice. So on 12/31 of 2022, Mr. Rangel has now used the gym for the last year. Maybe he never went at all. That's what happens in my world. Okay, so I have memberships to the gym, but I don't go. And so I just keep giving them $53.90 every month. Wow. Okay, so unearned revenue and revenue. So we are reducing the unearned account because now we have earned it. We created a liability here, and then as time passes, we earn the money. So it's 1/2 of it because it was a 2-year membership. Then another year later, on 12/31 of 2023, we will do the exact same entry again. So when we do this entry, oh, thank you. We will do the exact same entry again. So now we have earned the whole thing. So now Mr. Rangel's got to come in and he's got to give us another $2,000 to get another 2 years worth of gym membership. So when we started this, just so you can look at the unearned revenue account a little bit, we start off by putting 2,000 in there. And then on the end of each year, we removed 1,000. So at the end of the 2-year period, then the balance in unearned is 0. Because now it's all earned. All right, we did the sales tax example. So now I think we're ready to move on to our long-term liabilities. So long-term liabilities, the only one that you've really learned about so far is notes payable, and it's when we owe a note that's longer than a year. But we also need to talk about bonds. And so bonds are a separate topic that we need to cover. And then after bonds, we will go on to actual loans. So at the bank. So I think this is a decent stopping spot. So I'll stop here and then I'll restart. So.